welcome back to the Tax Sisters podcast. We are here with some exciting news. If you'll both notice, we are both wearing long sleeves. It's sweater weather.
It's sweater weather in the morning.
In the morning. We're super excited. We hit when I woke up this morning and we were doing our walk, it was 65 degrees. And that's a huge downturn from the 82 we were walking in or trying to walk in last week.
Yeah.
It was brutal.
But by the time we leave, it's still almost 100. So,
yeah, exactly. Well, we are here to talk about a couple of things today. Health insurance and HRAs, along with retirement plans in the small business world. We want to touch on kind of the things we normally see come across our table, what the right way is to handle those things, and what are some good tips and tricks on how to manage that in your kind of day-to-day with yourself as a single person or if you have employees as well.
Yeah, and basically using these as tax strategies going forward. I know when we talk about health insurance, and it's funny because I was just reviewing someone's books yesterday, day before yesterday. I don't know. It was before the tax deadline.
It's always, yeah.
And I noticed that, they were expensing, they had an expense line item called health expenses, I think it was.
Yeah.
And in there was their insurance premiums and their trips to Walgreens, their doctor's visits.
Massages.
Yeah, massages. People try and stash those all the time. And, so I had a little chat with the owner and I was like, so do you have like a Section 105 plan or an HRA? Like, what do you, and they just kind of glazed over and thought, no, I just talked to so-and-so and they told me that I can make all these business expenses because I don't have any other employees.
Yeah.
And I've always done it that way. Nobody's ever said anything. That's kind of a classic line we get a lot.
Right.
I've always done it that way, or my 5 best friends all do it that way. So it must be okay. I thought that today this was going to be a good topic because it is kind of common, and I think it's not something you see. I know I don't see a lot about this online with health insurance premiums and small business and stuff, and it's not as well out there explained on how to do it. But it is.
Most small business owners think health insurance or different plans are so out of reach for them.
Well, and they are. I mean, it has become that way.
Yeah.
I agree. But there's still a right way to make this a part of your business deductions and tax strategies, and a wrong way. And I would say, there's quite a large percentage of people out there that just aren't educated on how to do this properly. So we thought we would talk a little bit about that and how to utilize these to gain better tax savings. So it's very important that we do it and we do it strategically and you have a plan for it. So just like anything.
Yeah.
That's why I think understanding that just because you put it in your books as a health expense, it's not the right way to do it. But we have talked in the past podcasts about different organization structures, LLCs, partnerships, single member LLCs, S Corps, C Corps. And actually, this is a really good example because these are health deductions are treated differently depending on how you're organized.
Yeah, definitely.
So we're going to kind of walk through some of those, and hopefully this will help some of you all out. And we'll do it like by entity.
I think by entity is the best because then our viewers can see, how each person or how it's applicable to them. So let's just start off with the simplest form. Let's do the single member LLC.
Yeah, single member LLC or an informal sole proprietorship, one that maybe you just, 30 other houses or whatever. I don't know, whatever the case may be. What's interesting about that, probably most of you that are self-employed, like I said, very informal, self-employed, have a Schedule C on your tax return.
Yes.
Probably are aware of itemized deductions, mortgage interest, your health costs, your donations, your
property taxes, all those things.
All those things. And we try, you try real hard to get over that standard deduction so we can start, deducting more.
Yeah.
Which can be a challenge since they've raised the standard deductions up fairly high. Right. It's harder for people to get over that. But what I think also that people fail to remember is that health expenses Even if you spend 10 grand in health expenses, if you are making 150,000 a year, I mean, that almost none of that is even actually considered part,
No,
even
you have
remotely
to,
deductible.
yeah, you have to
So
get over for it to count. So if whatever your threshold is 10,000, only 10,001, that $1 starts counting after that.
yeah, so it's not a really good deal. But when you're self-employed, especially if you don't do your taxes yourself, because that usually ends up like a mistake. I think that I've picked up on quite often when I'm reviewing returns, is if you're self-employed, there is an above the line, what they call an above the line deduction. So you can get a health insurance premium deduction while not itemizing.
Okay.
So we can pull that out if you are self-employed, but you have to have a self-employed income in order to do that.
Right.
They're not going to just let you deduct that, especially if you're not making any money, then that's probably not going to help you very much. But what you can't do is put it on your Schedule C as an expense.
No.
And then go negative,
right.
Or take a big loss. So with sole proprietorships, they're probably the simplest way to handle them is just knowing the proper way to report them on your tax return. To get that.
There's no special way. You just have to, apply it properly on
Correct.
the 1040. And then there is also a second option. It has a fancy, what are those acronyms? QSE, HRA.
QSERA. For short, that's what they call it.
Really? QSERA? I would have never known. But it's called a Qualified Small Employer HRA. Give us some deets about that.
So what's nice about that, and you'll hear us talk quite a bit about things called HRAs.
Yeah.
This is just a type of HRA. But it is a plan that you can put in place in your business where you can actually reimburse yourself for, or basically have the business pay your expenses. These plans are really nice. They're really flexible, but they are official, which means they have to be established properly and done to code. It's not.
They have reporting requirements, paperwork that has to be filed. Normally, there are businesses or something that actually help you put the plan in place and make sure you're following all the rules.
Yeah, but it's not that really high maintenance.
No.
Usually pretty inexpensive to get the plan set up.
Yeah.
And what's nice is, so not only would your premiums be tax deductible above the line, but your expenses, your co-pays, your prescription drugs, there's a nice list of what qualifies under the HRA plans, would then be an eligible business expense for the business. So while we see a lot of mistakes with that, the fix is quite easy to and inexpensive to remedy and make sure that you can take advantage of these tax deductions.
Right, yeah. It's pretty much just like a maintenance thing, right? The people who are helping, put the plan in place, it's just maintenance, helping make sure the things are reported properly.
Yeah, but I wouldn't sit around and wait for your tax preparer to give you these types of tidbits, because they don't know what you're spending money on and what you're spending your medical on and how you're organized, and they're not into the weeds on all of that. So understanding how that works for yourself and inside your business, I think, is really important. Yeah.
And even nowadays, I think about how many people just don't even bother capturing all their medical and stuff anymore. They're like, I'll never get over the itemized, so they don't even capture it.
Bother it.
Yeah, they don't even bother. But if it is 10, 12, whatever thousand, it could be more beneficial to put these plans in place.
I agree. Why pay with after-tax dollars when you can use pre-tax dollars?
Agreed.
I agree.
The second one we're going to jump into is a common one, right? Our S corporations. They're able to do a little bit of the same, but let's kind of jump into the differences they have.
A little bit trickier with an S corporation, and probably done on purpose by the IRS. But with S corps, any member that isn't more than a 2% owner, so not a very big, doesn't have to be a very big owner.
No.
And most S corps are, I guess, small. They don't have a lot of 2% owners. But in that regard, then you can't actually put a plan in place that allows your business to pay any premiums for you. So say you even have an S corp and you have 10 employees and you provide everybody pre-tax health insurance. You have a Section 105 plan in place. You have everything done and you're doing pre-tax deductions for your employees. The problem is you cannot participate. You can participate in the plan. However,
Right.
what the company is paying for your healthcare premiums actually has to also be reported on your W-2 as wages.
Yep.
So people are like, well, what the heck is the point of that
if I have to pay taxes
if I have to declare it as wages and pay taxes on it?
Well,
it doesn't make any sense. But that's how that works. And then what happens is as the S Corp files its return and you get your K1, there's a pass-through deduction above the line that you can take, just like with the self-employed, to as long as the S Corp is profitable, you took a wage. There's a bit more restrictions on what you need to do to make sure that that's a legitimate deduction.
Right.
But it can still be done. It just needs to be done properly. But it is a lot trickier navigating with an S Corp, so you might want some help from your tax professional or your and your payroll company as well for proper reporting, because it needs to show up on your W-2 as S Corp 2% owner fringe benefit. So there is quite a few details that need to kind of get into place if you're an S Corp in order to do that. But you can still use the HRA.
Yeah.
In these types of situations. So I think that you're going to see a common theme here, that's when you're in a smaller business, maybe not required to provide health insurance to your employees, but you want to provide assistance, you just can't afford the extreme costs of the health premiums. Then these HRAs are pretty, awesome, because someone can go out, they can get their own health insurance plan. Maybe they're even covered by a spouse. But now they have an avenue or a pocket of money that they can access to pay, maybe they have a high deductible or something like that to start assisting them. So it still becomes, I think just as valuable, and in my opinion, more valuable, but that's me.
Well, we see one of the examples, I was actually talking to one of our clients the other day. They're like, yeah, we only put so much on our FSA, HSA or whatever. Once we're out of that, we have to hit our deductible. I feel like we're in a tight spot. There's no more extra money to spend because there's many people don't have extra money to spend on $10,000 in medical expenses, or if they have a procedure. So that avenue was really smart for them, because it feels like an additional FSA, an additional AR.
Yeah, agree. So, but the real caveat here, I think, is to just be careful with this one. If you're an S Corp, you probably want to seek out a little guidance and assistance, making sure that's set up properly.
Of course.
But still extremely powerful. And
it's going to be more popular, I feel like, the more it's gaining traction.
And if you're an S Corp that has no other employees and you're the only employee, you can have an unlimited HRA and it not be capped at all.
Yeah,
so
just endless. Put as many massages as you want on
which
there.
Can be quite nice, especially not because anyone wants to spend a lot of money on medical stuff, but the occasional time or the year that happens, you at least have a way to make sure that it's tax deductible.
Yeah, and the kind of society in general, I feel like health costs, keeping yourself healthy, in general, is skyrocketed. It is all the rave, but keep yourself healthy, but
agree.
And the last one we got here is C Corps. So,
C Corps are by far the easiest and most flexible, because you can be the owners, employees can all participate in tax-free, those tax-free fringe benefits and group health insurance programs and all of that. So it's definitely, it's even easier than a sole member LLC. But, obviously C Corp comes with its own pros and cons. But in that formation, we don't have to worry too much about the owners and how we report those. Yeah,
well, the owners become, or, the shareholders become, one in the same as the employees. Correct. They have no special caveats or anything like that. So everyone's on the same kind of straight line there. So it's just a little bit cleaner for them to take those premiums as a straight business expense.
Yep.
That covers the different ones. We want to talk about how using your HRA can be very strategic in a way. We have plenty of people who kind of come to us at the end of the year. What can we do? Is there anything else? And a lot of people think tax planning is like, what can I buy? what am I putting in my retirement? What am I doing this? But these can also be very strategic as well. We've had people who are like, haven't had this in place, and this was a difference maker for them in the last couple months of the year.
Absolutely, because that's true, because we were able to back into like a whole year's worth of stuff. So let's talk about you hear us calling the initials HRA. Not to be confused with an HSA. It's an HR, Romeo. And what that stands for is Health Reimbursement Account, a health reimbursement. You also hear it called a couple different things on the A there. But basically that's what it is, a health reimbursement arrangement that you make. And that plan has to be, put in place just like you would a Section 105 for your fringe benefits anyway. You put that in place. And what's nice about also to really think about this is it's a way to give your employees additional funds to help them support their life or help them with their health care if you can't afford to provide health insurance benefits. It's tax-free for them, right? So they're getting reimbursed. It's not income, so they're getting tax-free funds. The employers are not having to pay, employer taxes on the wages, on the money that they're providing to them. So it's a double bonus, in my opinion, on both ends that, it's part of someone's overall compensation to be provided this. So keeping that in your, back pocket, you're talking about quite a significant savings on both ends there. So that's why they're a good strategy to put that in place. Yeah. And
one of the other things that people really love, especially the owners, even if they have a couple employees that they are offering this plan to, there's no pre-funding requirement. So it's not like, okay, I'm going to offer my employees each $5,000. They don't have to just give them $5,000 up the front. It's as they spend it, that money comes trickling out. So it's a little bit more flexible. Right?
It's a lot more flexible.
Yeah, so it's a little bit more, strategic, and you're planning ahead. Because sometimes dumping $10,000, $20,000, $30,000 isn't an option. But as people spend it, co-pays $25. It comes out a little bit more easily.
I agree. And, administratively, a lot easier to manage for the business than even a healthcare plan, less requirements in reporting. There's compliance, of course, but it's definitely not as burdensome.
Right.
So extremely flexible. So I really tell all of my clients they should think about this as an option and really look at what they spend every year, because even if it's not a lot adds up. Right?
Oh, a little bit of something is better than nothing.
The average family, I forget what they said, what they spend, on healthcare costs. But when you really start looking at out of pocket, I look at my family, the regular prescriptions, you go to the doctor, you got to do this.
The dentist. The dentist costs like $10,000 every time you go. I swear.
But exactly, it can be used for the dentist as well. And so it's kind of nice. So highly recommend that you all kind of think about that, look into it, see if it fits into your business structure, and it'd be good for you.
And the big takeaways from the plans that we have in place is that, when using the HRA, the Health Reimbursement Account, the employers can deduct the contributions as a business expense. So while the employees are receiving their reimbursement for there are qualified things, so you can't just spend it on Botox or whatever. It makes them tax-free. So it not only is helping the employee, but it's also reducing the overall tax liability for the employer as well. And then the second is going to be that flexibility and the cost control for the employers. So being able to, know that, hey, I'm providing this pretty much an asset to the employee tax-free. I don't have to come up front with it. I'm just not going to empty the bank or anything, but it's able to, give them that peace of mind for the employees while also, helping the employees out.
And of course, that last one, whereas, we've been in a position where you're trying to interview somebody.
Totally.
They seem perfect for the job and they give you the question, do you have benefits, health benefits? And you're like,
Yeah.
And they might take a job with lower pay because they can get health benefits. So what this also does is allows you to be a little bit more competitive in the industry and attracting talent. So it's like, no, we don't have health insurance, benefits, which sometimes you find are, some of the plans that you do get in smaller companies are kind of trash because they have these
So hard.
big premiums and really high deductibles and not, you get a little benefit, but not a ton unless something significant happens. So these HRAs are like, it should cover your own premiums. If you want to go get your own
health insurance,
even from the marketplace or whatever, you can use it for your co-pays. So, we try and, pump it up as it's more valuable.
Yeah.
So
the flexibility and your own choices, right?
Helping to attract talent and keep people, I think, has been really helpful.
Yeah.
It's really helpful.
Yeah.
So we want to talk about retirement plans.
We do.
And how to leverage or how to utilize them inside your business as a tax strategy.
Yeah.
So,
and the importance of saving for retirement.
I recently was talking to somebody who we were talking about, I think it was when I was doing their taxes. I shouldn't say recently because it was probably months ago at this point.
Feels recent.
I don't know. When you're in tax season, everything just kind of lobs together. Where they had made a contribution to a traditional IRA. They had an S corp and they had a good year.
Yeah.
And they made some, good money. Their husband, has a 401k. They were also working at the time, I believe. We have a couple clients that have full W-2 jobs, but also run some pretty decent sized companies as well. And what ended up happening is their contributions to their traditional IRA got kicked out as in excess.
Right.
Because they were eligible or were working on a regular 401k with their employers, or they incomed out of it. They made too much money that year.
Went over the threshold.
Yes. So we had some discussions, and they were planned on, not working in their current employment anymore, move into a full-time S corp.
Yeah.
Employee themselves. Right. And they were like, well, how do I keep this from happening? And what do I do? And I'm like, look, you really need to look at how to leverage the retirement plans inside your business so that some of these other rules and stuff don't really apply.
Right.
And we talked about a couple of different things. In their case, a solo 401k, which is solo K. You probably also heard that term. SEP IRAs, simple IRAs, and 401ks. And what the pros and cons of those were, how to use them, where to get the maximum flexibility and tax benefits from.
Right.
So just, these kinds of things do evolve. And the thing about retirement plans is you really want to think about where you're going with it, because it's not always easy to change from one form to another. If you start with a simple IRA, there's too many rules with how long the funds need to be there before you can roll them over or bring them into a 401k. So you really want to think about,
long term.
Yeah, a little bit more longer term. And I think what we're seeing a lot more people do is getting that 401k, even if they're not going to max it out, because of the flexibility that it generates. So we're going to talk about a couple of these different options, how to utilize them inside the business and get some good bang for your buck in there. So
I'll start off with the solo 401k. So a lot of people, actually it's designed for self-employed individuals. So uno person with no employees. And it's a really good tactic because not only are you the owner of the business, right, but you're also the only employee. So you get to contribute both as an employer and the employee to your personal solo 401k plan. So it's kind of like a double dip. They have pretty good contribution limits. If you're under 50, what is it nowadays?
23,000.
23,000. And then if you are over 50, you get a catch up. So you get to, really get at it.
7,500 on top of that. If
so
you're
that
over 50, like me.
So if you're over 50, you can start cooking at $30,500 a year. But that is net of your self-employment earnings. So all in the max, you can only contribute $66,000 a year.
Which is a lot.
That's a chunk of change.
Compared
think about
to what you can do in other places. So that's,
Think about that. 10 years, 660 grand. Every year, the threshold goes up a little bit too. So $1,000.
I think we're up another 500 for going into 2025. But what's cool is that last piece that the employee, the 25% of net self-employment earnings. You don't have to do that right away. Like you can calculate that. So it's it could be a very good end of the year tactic to be like, all right, do I want to contribute to this, save additional taxes?
What will it save me if I put it here, if I throw it there? A lot of people run between those things. Do I dump it into my 401k and save it for future me? Or do I dump it into assets? So it's always a planning game of what people want to do.
I'm a big fan of solo Ks, to be honest, especially with the companies where you really only have, obviously, one employee, and that's yourself, and maybe you never really plan on having on any other employees or needing them. It's very powerful, and I think very easy to set up, low maintenance fees, all those kinds of things. So I don't think that we talk enough about those just in general.
No, I think a lot of people just go straight to 401ks, which obviously a solo 401k is a form of a 401k, but it's super powerful. Like there are a lot of benefits for single member only employee companies. A lot of it gets lost. They always think everything's always just thrown out as, if you have this big company, you got to do this, this, and this, and everyone just feels left in the dark if they're a one-man shop.
Right. Next, though, on that list, thinking of more of the smaller company stuff, is the SEP IRA.
Right.
And Simplified Employee Pension is what that stands for. Yeah. I'm not a fan for because I think it sounds like it's way more than it really is on a SEP IRA. Yeah. I don't recommend them typically for people that are in S Corps, but a lot of financial advisors like them. So we'll get people coming to us saying that, I contributed to a SEP or something like that.
I think they use it a lot because it's pretty cut and dry. There's not a lot of thought behind it. So they just take, up to 25% of your annual compensation, and you can throw it into the SEP IRA with that same max of $66,000 a year. So I think for financial advisors, there's not a lot of...
Right, and you don't have to contribute annually, and they're very low maintenance and...
low cost, low oversight, so...
I just prefer more of the flexibility of the 401k type of situation. But SEP IRAs... generally, you'll hear a lot about those because the financial advisors really like selling those. So. Right. But it is an option. Matter of preference, really, I would say they function similarly. Yeah. But different types of restrictions and stuff. Like, you're not going to take loans against your SEP IRAs like your 401ks and stuff like that. So there's still some more perks to a 401k.
Right.
But I'll leave it at that. As far as exploring your options on those, they're both pretty good options.
Yeah.
Then we get into something called a simple IRA.
Yep.
Because it's supposed to be simple. This is a nice starting program you'll see with
baby steps,
small business with maybe, under 10 employees or something small. They want to have a retirement, plan
an offering for their
employees. Maybe they don't want to do a huge matching. I believe
they want to give some, but they want to give
I think is pretty much the mandate on the simple IRAs. Employees can contribute up to $17,000, so it's a little bit lower of a threshold, and the employer would match up to 3%.
Right.
So it is a low cost, pretty easy to manage for a small business. Kind of leaves it with the employee how much they want to put away.
Right.
But not the same limits. It doesn't have any other types of options as far as what you're going to be giving your employees, because it's only up to 3%. But it is a nice little starting point. I would say really the biggest downside to a simple IRA is its lack of flexibility, and it has a lot of rigor around how long the money needs to sit or how long you have to have had it open before you can roll it over to something else. And it has some really strange rules in that regard. So if you're looking into a simple IRA, I really suggest obviously evaluate all your options just to make sure that that's right for you.
Yeah.
It is used a lot. I don't hate them by any means.
No.
I think they're just a little more inflexible. So if you're in rapidly growing business, down the road you're going to want to offer a 401k or something like that, you're just not there yet, it could be a good option for you.
Yeah, definitely. And I do know, like, you can eventually roll it into a 401k, but like you said, there's like a term limit.
It has 2 years.
Yeah, it's got to sit there for so long, etc. And then we got hitting our last one, the one that's most common, and I'm sure most of the people hear about the most in just corporate world, is the 401k with profit sharing.
Yeah, well, we hear about the 401k, I think,
and
a lot.
Profit sharing second.
It's kind of a separate thing, but that's what's nice about the 401ks as an employer. So a little bit on the con side, a little bit more rigor around the 401k reporting requirements. They're usually a little bit more expensive of a plan to get into.
Yeah.
But generally, the most flexibility, the most contributions. They can be set up multiple different ways. We try to get people to do these a lot with this profit sharing component.
Yeah.
Because it allows us to look at basically after the year is ended, we'll look at where our profits stand or a tax burden stands and be like, do we want to disperse profit sharing out to, and there's formulas and stuff that they all use. Stuff. It has to be compliant. We don't get we could set we want to give out $25,000 to the employees, but they have to basically decide how it gets distributed so it's fair. But what's nice about that though is the amount that we can sock away in that profit sharing realm on top of we will even recommend these over solo case sometimes if people have highly profitable businesses so that we can lap on that profit sharing portion.
A good chunk,
and these people can sock away a ton of money. So, but really good ways to look at how to add value in your business, how to implement this as a tax strategy, how to
retain the talent,
retain employees.
It's like a bonus. Obviously, you're not getting the bonus. You're bonusing, like my favorite thing, your future self.
Exactly. So think about all of these. These are really important decisions for your business, but they're really powerful tax planning strategies.
Right. Yeah. And I think some people kind of put these to the wayside, but, saving in general for retirement is super important. Not only is it, you're earning money, you're investing in yourself, but you're also reducing taxable income as it happens right now.
Yeah, exactly.
So,
well, we appreciate your time. I do want to say that I think we are going to have a guest next week that maybe can come and talk to us about how they've implemented some of these tax saving strategies.
Okay.
Or how they have received them, what they knew about them before, what they've learned, all of those kinds of things, so that we can kind of have a real life demonstration of what this will look like.
Sweet. Thanks for visiting us today on the podcast. We'll see you next time.
Thanks, guys.